Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous?
It's a new trading day. Welcome to Modern Investing Techniques, episode 101. I'm Patrick in Vancouver. Today is July 9th, 2026. Time to break down today's market setup and find our edge. Quick reminder, everything we discuss here is for education and entertainment. The practice investment of the day uses simulated trades with no real money. I'm not a licensed financial advisor, and this isn't financial advice. Always do your own research before putting real money to work. Costco's strong June sales give Canadian TFSA investors a concrete signal to watch consumer staples for relative stability amid geopolitical noise. The S&P 500 closed at 7,483, down 0.3%. The Nasdaq Composite finished at 25,871, up 0.2%. The TSX Composite ended at 34,936, down 1%. U.S. futures are mixed as renewed Mideast hostilities and chip stock rebounds dominate sentiment. The Bank of Canada's next interest rate announcement is scheduled for December 9th. Consumer staples and select healthcare names are showing relative strength, while broader growth indices face volatility from supply shock concerns. Our simulated portfolio sits at a cumulative profit of $304.47 across 40 trades. That translates to matched window alpha of 11.2% versus the Nasdaq across 35 benchmarked trades. With the broader tape setting a cautious tone, let's turn to the one name our models flagged for a simulated weekly hold today. Schwab's warning that the era of easy index gains is ending points directly to a volatility-adjusted allocation approach. This strategy involves screening for stocks or sectors with depressed multiples that can buffer against macro shocks rather than chasing pure momentum. In today's environment of more frequent geopolitical events and supply disruptions, the tactic starts with pulling a list of names trading below their 200-day average on elevated volume. Investors can implement it on Questrade or Interactive Brokers by setting alerts for volume above the 20-day average combined with forward PE below sector medians. The approach worked best during 2022's rate hike cycle when value and defensive holdings outperformed broad indices by wide margins. It carries the risk of prolonged underperformance if growth reaccelerates, so always pair the screen with same-day volume confirmation to avoid false rebounds. That same defensive mindset applies when Canadians look beyond their homes for real estate exposure. This is a simulated trade for educational purposes only. No real money is involved. Our practice investment of the day is a weekly hold on Costco Wholesale Corporation, ticker KOST on the NYSE. The catalyst is Baird reiterating its outperform rating after robust June same-store sales that exceeded expectations. Technical setup shows price action above the 50-day moving average, with volume tracking near the 20-day average. Nearest support sits at the recent swing low. We set a stop loss 6% below entry to limit drawdown if consumer spending weakens further. The 5-day target is plus 3% to plus 6% if sales momentum holds. Confidence level is medium because the sales catalyst and analyst support are aligned, but broader retail sector volume confirmation is still needed. This setup demonstrates how to use an analyst reiteration as a secondary filter rather than a primary signal, forcing us to verify volume and sector breadth before committing capital. Listeners learn to treat upgrades as confirmation tools instead of standalone triggers. Now, here's something that most retail investors get wrong, and it cost me money before I figured it out. Imagine you added a REIT position to your TFSA last month, expecting steady distributions while home prices stalled. Your order filled cleanly, yet the actual economics depend on whether the trust uses mortgage debt, property-level leverage, or both. Publicly traded REITs, such as RioCan or Canadian Apartment REIT, trade with daily liquidity but distribute most taxable income, creating immediate tax drag inside non-registered accounts. Mortgage investment corporations offer higher yields through private lending, yet carry liquidity risk and different tax treatment as interest income. The professionals always check the distribution composition and debt to gross book value ratio before allocating, because a 60% payout ratio funded by new unit issuance is not the same as one backed by rising rental cash flow. The biggest mistake with real estate exposure is treating every vehicle as equivalent to owning physical property. Instead, always match the structure to your account type and time horizon. Netramark's platform applies machine learning models to phase 2 clinical datasets to identify patient subgroups and endpoint signals faster than traditional statistical methods. Canadian investors following healthcare names can use the resulting probability outputs to adjust position sizing ahead of binary trial readouts. The service is accessed via contract research organization partnerships with no public retail tier listed yet. Time's deployment of Content Stack's platform shows how media companies are embedding AI-driven personalization into publishing workflows. Portfolio managers tracking digital advertising revenue can monitor similar platform adoptions as leading indicators for sector rotation into ad tech or SaaS names. Access is enterprise-level, so individual investors can follow implementation announcements via company filings. AstraZeneca stock dropped 9% after a heart drug trial miss dealt a rare blow to the pharma powerhouse. A late-stage trial failure removed a key pipeline catalyst for the United Kingdom's largest drug maker. The setback triggered an immediate repricing across the shares. AstraZeneca had been viewed as a consistent performer in the pharmaceutical sector prior to this result. Investors received the news as a direct hit to future growth expectations in the cardiovascular category. The company now faces questions about how quickly it can replace the lost catalyst in its late-stage pipeline. Trim any existing healthcare exposure if the stock closes below the 50-day moving average. The winning trade of buying chips and selling software is falling apart as relative performance narrows. The 2026 leadership dynamic between chip makers and software providers has begun to reverse. Relative performance between the two groups has tightened noticeably in recent sessions. Sector participants had previously favored semiconductor exposure over software holdings for much of the year. The narrowing gap is prompting portfolio managers to reassess existing weightings in both areas. Index ratios that track this relationship are now approaching key technical thresholds. Rebalance any tech sleeve by reducing chip overweight if the ratio of SOX to software indices crosses its 50-day average. First Chinese EVs have arrived in Canada, but they come with a high price tag and tariff hurdles that limit near-term volume. The new entrants expand the range of consumer choices available in the domestic market. Tariff measures and infrastructure limitations continue to constrain sales momentum in the near term. Pricing levels for the incoming models sit notably above comparable vehicles already on Canadian roads. Industry observers note that dealer networks and service support remain underdeveloped for these brands. Policy decisions out of Ottawa will determine whether additional supply chain commitments become viable. Avoid adding EV supply chain exposure until tariff clarity emerges from Ottawa. PepsiCo beat revenue estimates but flagged continued pressure from tighter household budgets. The company highlighted ongoing challenges tied to reduced consumer spending power. Despite the revenue beat, management pointed to persistent caution among budget-conscious buyers. Product innovation efforts are centered on healthier options to recapture wallet share. Volume trends in core categories remain sensitive to any further deterioration in household finances. The quarter's results reflect a balance between defensive staples characteristics and cyclical demand risks. Hold consumer staples positions, but wait for volume confirmation above the 20-day average before adding. Our simulated portfolio across 40 trades shows a 58% win rate with 23 wins, 16 losses, and 1 break even. Average return per trade sits at 0.76%. The best trade delivered 20.11%, while the worst came in at minus 11.80%. Current streak is one win, and the AI analysis continues learning from volume and sector patterns to refine future screens. Open your brokerage screener, filter for consumer staples names with June sales beats and analyst reiterations. Then check whether today's volume exceeds the 20-day average on any candidate before adding it to your watch list. Before we wrap, watch for how the chip and software rotation settles into next week's price action. That's it for today's Modern Investing Techniques. The resources page has links to everything we discussed. Subscribe and share with someone who wants to go beyond index funds. See you tomorrow. And if you'd rather watch than listen, find us on YouTube at Nara Network. Links in the show notes. And before you go, this show is part of the Nara Network, a family of daily podcasts on tech, science, and markets. Each one a short, sharp briefing you can finish on the commute. If today earned its place in your feed, here's your next listen. SpaceX Daily, the daily companion for following SpaceX as a public company, from Starship to the stock ticker. Find every show free at naranetwork.com. Following the long arcs? Story trackers on naranetwork.com follow major programs across episodes: Tesla, SpaceX, AI, space science, and more. This episode used AI voice synthesis of my voice. Editorial selection and analysis are my own.
Do you ever wonder where we go after this? Are you high right now? Do you ever get nervous? Do you ever stay awake, counting sheep like all the time? What's your life like? What's your purpose? When's your birthday? What's your sign? Are you down right now? Are you stuck up in the past? Are you still thinking about all the times that you didn't laugh?